everyone, welcome to ABC Talkshow. Today we have Timothy, Kimberly, Connie, and Avy. I'm glad to invite four of you to my show. So without further ado, let's move to our topic. Today we are going to discuss about the rise and fall of the Japanese yen. So later I'm going to ask some questions about this topic, and after that you guys are going to answer the questions to everyone. So basically, Japan is a country with full of prosperity from then until recent years. The legal tender of Japan is known as Japanese yen, which has the highest value currency in the market after the US and Euro dollar. To be more specific, the meaning of yen is described as circle or round jet. The Meiji government, which is the official Japanese government, has adopted this currency in the name of the new currency at the year of 1871. So here comes the first question. What was the reason that the yen carried trade war during the early 2000s, and also why did it stop working after 2008?
Thank you, Alden, for asking that question. So yeah, I will be answering that. So the reason why there was a rise in the carry trade in the 2000s and it fell in the 2008 was complex and had little to do with the Japanese economy strength because there was little evidence to support that. So in Japan's case, during the early to mid 2000s, the weakness of the Japanese currency was due to the carry trade. So carry trade is defined as a trading strategy involving low interest borrowing and investing in an asset which provides a return which is higher. It has been also described as one of the most well-known currency market trading strategies and is of similar character of the motto buy low and sell high. So the yen dollar trade was regarded as one of the most well-known carry trades for nearly 20 years before the global financial crisis. It grew because from the mid 1990s onwards, interest rates in Japan were kept exceptionally low in an effort to enlighten Japan's stagnant economy, while the US Federal Reserve showed an opposite trend whereby the country kept interest rates higher. So investors at that time saw the opportunity to borrow loans in Japanese yen, which had low interest rates, and invest money in profitable assets such as the US Treasury bills, as mentioned just now. And now going back to the early to mid 2000s, the US Federal Reserve raised the interest rates even higher, which caused the spread between the US and Japanese rates to widen. And this triggered an unexpected increase in the yen dollar carry trade. So people such as the individual currency traders, banks, hedge funds, financial institutions also participated in the yen carry trade in pursuit of high returns. And here comes the fall of the yen carry trade. So this was when the GFC struck, which is also known as the global financial crisis, which occurred in the year 2008. So this financial crisis was described as one of the worst economic catastrophe since the 1929 stock market crash. The GFC began with a subprime mortgage lending crisis in 2007 and developed into a global financial banking crisis in September 2008, along with the failure of the investment of the Lehman Brothers. So there were a lot of large bailouts and other steps intended to mitigate the spread of the damage, but it was proven unsuccessful and the global economy succumbed into a recession. So basically the US Federal Reserve lowered the interest rates abruptly to eliminate the difference in interest rates between US and Japan. And because of this, the basis of the yen dollar carry trade has diminished and has become unprofitable. Yeah.
All right. Well, there is a good question, but what caused the increase in the value of yuan between 2008 and 2011?
Alden, so to answer that question, so as I mentioned just now, after the GFC struck, the yen rose speedily as Japanese investors and all the financial institutions, they sold their risky US dollar denominated assets. And then after that, they buy back the yen. So, and just because of this, the yen value was became higher. The value just drove higher. And because of this appreciation of yen value, it had a deep impact for Japanese exporters, as 40% or as a 40% increase in the value of yen versus the US dollar between 2008 to 2011 has hurt the value in terms of profits earned overseas when that value is converted back to yen. Besides that, a strong yen also affects Japanese exporters, as it results Japanese goods in being less competitive. So for further illustration, I'll take Toyota company as an example. So in the year 2012, their estimated profit was about 200 billion yen, and this was a significant decrease in profit, with pri in 51% decrease of profit from the prior year. The increase in this yen dealt a harsh blow to the Toyota company because half of the cars that they produce are in Japan, and so when it sells worldwide, the value it's hurt the value of their profits in during the year 2008 to 2011. That's it.
All right, thanks for the answer for the Timothy. So how did the policy under the government to purchase government securities help lower the yen's value and the mechanism behind it?
So Abe had campaigned on a platform that included taking steps to weaken the yen's value to help Japanese exporters before the elections. The policy of Abe's government purchasing securities was intended to expand the yen supply, but it drives down the yen value and creating a higher inflation target. Indeed, the events between October 2012 and December 2013, the yen lost 25% of its value against the US dollar. As a result, the purpose in the increase of yen supply was intended to make Japanese exports more attractive. Although this benefited Japanese exporters, other major industrial nations have criticized the strategy as unilateral action that has come dangerously close to precipitating a currency war. The mechanism behind the work here is currency manipulation, which helps to achieve an unfair competitive advantage. To put it simply, a nation is selling its own currency to weaken its currency and purchasing foreign currency. The result is that, according to the law and supply demand, the manipulating country decreases demand for its own currency while it increases the demand for foreign currencies.
All right. Do you think the Japanese government is engaging in current manipulations? If so, what should other nations do about that?
Yes, the Japanese government is engaging in the currency manipulation. The Japanese government used a currency manipulation policy to synthetically lower its exchange rate to gain an unfair advantage. Between October 2012 and December 2013, the exchange rate of the Japanese yen against the US dollar depreciated by more than 25%. In December 2013, the Japanese yen bought $1 for 104 yen. This has helped Japan to boost its export at the same time affect the import. This will indirectly boost domestic demand and increase the work opportunity in the export sector. Moreover, the reduction in the value of a currency will also able to boost the tourism of Japan. The number of foreign visitors to Japan in 2014 exceeded 30 million, which has increased by 29.4% compared to 2013. However, currency manipulation will bring a negative impact on other nations. For instance, in the short term, the US trade deficit will increase, thereby reducing the employment opportunities and output in the import and export industry. On the other hand, currency manipulation will also lead to low productivity and affect the economic growth of a nation in the long term. In order to prevent currency manipulation and protect the free market or free trade principle, other nations should provide clear guidance on the use of monetary value, as this will help a country's export from being abused. Lastly, the World Trade Organization and the International Monetary Fund should ensure that all future trade agreements must contain strict and enforceable currency rules. This means that any country found to have violated the rules will lose the benefit of the trade agreement. Thank you.
All right. Thanks, Connie. As the devaluation of the Japanese yuan has affected other currencies significantly and the global economy as well, do you think the domestic and overseas investors still can survive and earn the profit?
Yes, the advantages of a weakening yen consists of higher profits for exporters, as North America accounted for about 1/4 of Japanese listed companies. Meanwhile, imported inflation from a lower currency often drove in efforts to consumer deflation, particularly in the wake of low price of oil. Importer and non-export laborers who are likely to face higher costs at the grocery store without having extra income in their paybacks, which can also be considered as one of the losers from a falling yen. However, the adverse effects will reverberate worldwide with fiscal stimulus of up to 4% of the gross domestic product and further currency easing in the pipeline. The continued decrease in the value of yen has indicated a favorable condition towards Japanese exporters and increased domestic demand. It has caught a variety of foreign exchange experts and investors who believe that other Asian currencies will be impacted by the flow-on effect. Based on the favorable currency circumstances, Japanese exports had increased by 2% for the past couple years, while China and South Korea had increased by 20%. To a certain point, it alleviated the possibility of war in Asian currency, which it also greatly increased the number of tourists by 27% in 2014, and getting the benefits of the weakened yen through the tourists visiting in Japan. That's
Right,
all.
I see. Now I get the meanings. As mentioned by all of you, what lesson can learn from cases about the way of foreign exchange market operates? Can any one of you briefly talk about it?
All right. Thank you, Alden. So the lesson that we can learn from the cases about the way foreign exchange market operates is that if the foreign investors purchase Japanese securities, the yen will strengthen as they sell the dollar to buy the currency, and vice versa, where yen will decrease if they sell the stocks for dollar. And weak yen will boost their business profit through export companies, which also drive the stock prices up. And through the selling of yen for foreign currencies may increase the investment risk tolerance and foreign direct investment. Other than that, if a bad economy or there is a change in stock prices, Japanese investors will minimize purchasing yen and selling their foreign currencies. And lastly, purchasing a higher currency like the dollar investment in higher interest rate, foreign government is needed in the foreign exchange because trader profit from exchange rate is different in two currencies. Back to you, Alden.
All right, thank you, Avy. You guys are so wonderful. I'm so happy to have a chance for talking with four wonderful people. Thanks, Timothy, Kimberly, Connie, and Avy. I appreciate that. To conclude, Japanese yen has played the most important role to every Japanese citizen as they are using this currency to pay their bill or make a purchase every day in Japan. In other words, it will influence the Japanese economy significantly as well as growth whenever a strong yen is existing, which means more products and services can be purchased at a lower price when Japanese citizens traveling to other countries as more unit of other currency can be exchanged. That's all for today. Hope you like it and see you next time. Bye.
Thank you, Alden, for having
Thank
us on the talk
you.
show.
All right. Thank you.